Hello, everybody. This is Christian Thwaites from Brian Janikowski. Hopefully, everyone can hear me. Welcome to our market update, and I'm joined with Rita Lee, and I'm getting the signal that it's all coming through. So that's great. There will be plenty of opportunities for Q&A. I think we've already got some Q&As already lined up, and so we'll get to those hopefully in plenty of time. And we'll try to keep it to about 20 minutes. Obviously, happy to go longer if people want to have go into a longer Q&A session. And also we'll be putting this up on the web as a recording if you want to go for it, want to refer to it later. As I mentioned, I'm here with Rita, and she'll come in a little bit. So I'm going to start with the headline question, which is why are stocks roaring and the economy tanking? And I think we'll go into some slides in a minute, but basically there's three reasons for this. Is that number one, there is a very big fiscal stimulus. Now, the CARES Act certainly has its problems and its issues, and may not be going to ideally the right participants and those most in need. But think of it as emergency relief or disaster relief. It's not replacing demand in the economy. It's just literally filling some of the hole which has been left by this almost total stoppage which we've seen. And the way I think about this economy is just like it's so unprecedented. It's almost like people just went on strike, stayed home, and we know that that's affected millions of people. And the kind of normal economic cycle issues weren't at play. We didn't have a lot of leverage. We didn't have a lot of overproduction. So you didn't have inflation. The economy wasn't running hot. There were no major asset bubbles. All of the things which normally, predate the arrival of a recession. This is obviously a very, very different one. But so the first big answer is, yeah, there's a lot of fiscal money which has been pointed at the economy. As I said, it might not have got everywhere it's intended to be, but and it's certainly not all deployed yet. But a combination of bills took us well over to $2 trillion in a combination of unemployment relief, the payroll protection plan, which I think a lot of people know, plus a lot of loans and loans to businesses, sort of tide them over. So that has helped a lot, and that's an obvious one. The other one is that well, I'm going to come on to it in a little bit, but it's the monetary stimulus. Again, quite unprecedented, and we'll kind of come into that in a little bit more detail in a second. But as I mentioned a few times in the blogs and elsewhere, what took the Fed 8 or 9 months to do in 2008, 2009, they essentially did it within 2 or 3 weeks, and they aren't over yet. So the Fed has led a kind of a global, massive amounts of easing and monetary stimulus, and that's been very beneficial for the economy. I'll touch on that in a little minute when we look at the Fed's balance sheet. The other point is, third point is that people are expecting a V-shaped recovery. Now, I don't think it's going to be a V-shaped recovery. V-shaped literally means that it's going to come back as fast as it declined, and I think that's unlikely, just because we're going to see such a massive drop in economic activity. So it's a bit like, you can't decelerate anymore when you've hit a brick wall. And so we have literally hit the economic equivalent of a brick wall. So I think it will be a little beguiling in some ways, because it's the economy's taken extreme examples, gone from 100 to 50 and bounces back to 55. You'll see a lot of economic growth and recovery, and a lot of high-fivings, and it worked. But as you know, the 55 is still way below its peak, and I think that's what's going to happen. It's going to be perhaps V-shaped, but the right-hand side of the V isn't going to be nearly as tall as the left-hand side of the V. So I don't think it's terribly helpful to talk about economy in terms of letter shape, but I think that what is clear is that capacity has been being taken out of the economy. There's going to be some major changes in consumer behavior, which will mean that this is a fairly long, drawn-out recovery. And in fact, when you look at the bounce back from recessions, you go back to the early 1900s. So you've got modern ones in there, as well as the Great Recession, all those the Great Depression. It takes at least 24, 26 months to recover. Now, I think this one will be slightly faster, just because the economic and fiscal tools deployed into it have been so much quicker. But it'd be tough to see the economy getting back to where it was in real terms, full-blown activity, inside of about 18 months. So that's the sort of third major reason why the stock market has been doing so well. Actually, let's go to the first slide, because that actually shows just how quickly some of the retracement has been. So there we were, floating along at 3,200, a great 2019 after a rather torpid 2018. People made a lot of money, and then we had this precipitous crash. And I spoke last time just about how quickly it took to go from peak to trough. Again, that was, I think it was in 22 days. Normally the time was more like 90 to 100 days. So this was very, very rapid. Now you can see that kind of V-shaped recovery, and the date is around about March 20th, and that's when the close downs begin to happen in earnest. California, New York, when it seemed that finally people were taking this seriously. And I think the market very, very quickly bailed, just because they had no idea what was coming at them. And then since then, we had this big drop off, and then in April, I think the markets recovered. The markets were down well over 30%, I think, from peak to trough, and then they recovered by about 15% in April. So you can kind of see that big kind of V-shaped rebound, again, not quite there at its peaks. And then what's been happening for the last few weeks is we've been traveling in this 2,700 on the S&P to about 2,800, and that's throughout the results period. So that's kind of seems to be where we're stuck right now. But this leads me into another comment about the why is the market done so much better than the economy. And this is a cliche, but and some of you have heard it before, and it's like, the stock market is not the economy. It's a $21 trillion economy and about a $26 trillion stock market, but those two numbers are not really related at all. One is an income, the GDP. One's an asset, the equity side. But the major point I'd like to make here is that the stock market is very heavily tilted towards technology, 24% of the S&P, and healthcare, 14%. And communication services, which is mostly Google and Facebook and some Verizons and AT&T, which is another 10. So tech employs, US tech companies employ worldwide 3.2 million people. So there's probably about, let's say, 2.5, 3 of those are actually in the US and not overseas, out of a population, a working population of 165 million. So you can see that they're less than 2% of the workforce, considerably less, but 24% or more of the market. So you've probably know, as anybody else, how the market has moved. The technology stocks have done well, good earners, strong balance sheets, lots of free cash flow, some of them benefiting from the type of work habits which have happened during the lockdown and probably maybe likely to happen going forward. So it's cloud computing technology we're using here today. But so those stocks have been not immune from the turn down, but have certainly continued to generate huge amounts of cash. And they're talking about a slowdown in earnings growth, not a complete reversal. So, and it's the same with healthcare as well. I mean, a lot of the healthcare stocks in pharmacy and big big healthcare insurers and so on have done well, but they don't represent 14% of the economy. So again, I think the simple answer to that is the economy and stock market are really not good mirrors of each other. And what people are plowing into the stock market is often, a kind of a sector and a theme and a stock story much more than the broad economy. So let's go to the next slide. So this is kind of a prelude to this monetary stimulus, which we'll come on to in a minute. But I just wanted to show this because this is what the 30-year Treasury is at 1.3%, the 10-year Treasury 0.6%, and the 2-year bond at 0.17%. So these are, if you trace these numbers back 30 years, 50 years, 150 years, 200 years, you don't get any lower than this. Now, these are nominal rates. They're also slightly negative after adjusting for inflation, but let's not complicate the story. These are incredibly unparalleled low rates. And the Fed, as I said, moved very, very quickly to push down the federal funds rate, and the entire yield curve followed suit. And I think that these are going to stay at these rates for a very long time. The Fed, has repeated, and they did so in the FOMC meeting last week, that they are not putting any time frame on holding these rates low. They haven't even done what they did before, which was that it would be data dependent. So they haven't even come out and said, well, if the economy goes, up 3% and unemployment drops back down, we'll reverse it up. They are literally saying, we're here at these low rates, for the foreseeable future. And I think that will be measured, in years, not months or quarters. So that's where we are, sort of an incredibly low rate, and that's really driving a lot of the market as well, because stocks obviously take a lot of their cue from the bond markets, and if you have a low bond treasury market, it makes stocks relatively more attractive. Okay, next slide. This is the one which is just incredible, because if you kind of took this graph back 15 years, those blue lines would be almost non-existent. The only time the Fed had any money on its balance sheet is if it was doing any kind of repurchase or short-term money instruments. And it got up to, 3-4 trillion post the Great Recession, and the Fed was in wind down. There you can see it in 2019, slowly not reinvesting stuff, not buying any more stuff, and then boom, off it goes. And now we're at 6.8 trillion. I mean, it's a ridiculous moving average growth number, 5,000%. And you can see it's literally just stood up on its tail up there to take you way up there. Now, this is going to continue to grow. The Fed is buying treasuries, they're buying mortgage-backed securities, and they're buying a lot of repo and other assets. I mean, commercial paper and so on. But one of the major reasons it's going to continue to go up is because the government is issuing more debt issuance. So we went into this about 6 months ago with the US annual budget deficit roundabout hitting $1 trillion. Post the corporation tax cut, it rocketed up from about 700 billion to 1 trillion. It's probably going to go to 2 or 3, and no one's really counting. And it doesn't really matter right now, because how much the government issues and how much the Fed buys are really not I don't think that important in the overall scheme of things. But the Fed will continue to buy, and they are backstopping just pretty much every credit market around, which I think is very, very good, because they are so essentially preventing a liquidity problem morphing into a solvency problem. So liquidity, I think of just very simply as, do you have the cash to pay your bills? And if companies have got their cash tied up in fixed assets or inventories, then they haven't got the cash. And if they haven't got that, then they can very quickly go insolvent. So the Fed essentially has said, we're the liquidity providers, and keep as much of the business going as they can and as possible. So expect that to, this is we talked about the fiscal stimulus, the monetary stimulus. This is a big thing. And the Fed, I think, is way in front of its counterparts in the ECB and the Bank of Japan here. And, I think they've done an incredible job and continue to do an incredible job. And at the moment, if they were at all wavering or fussing about how much they'd allow the balance sheet to grow or what assets they would, not stand behind, then the market, I think, would be a lot more frightened. So they, I think, have helped a lot to steady some nerves. Okay, next slide. I'm just going to talk very briefly. This is another kind of version of that the US has done well, and I'm going to hand it over to my colleague. And one of the reasons the US has done well is because on the stock market side. Just it has a different exposure to different types of industries than a lot of these other international markets, and because of the monetary stimulus. But Rita, could you lead us through perhaps this slide, the next one, just kind of fill us in what's going on the international side?
Sure. So international stocks on this slide is the stocks 50. International stocks have declined along with the U.S. stocks, as you have seen, but they have not recovered as much. So until now, over half of the stocks 600, so the larger index, have reported, and the first quarter earning has been revised 25% in Europe, which is the worst since 2000, but similar trend across the world. As you know, commodity has been a big drag to the international developed and emerging market. So has the virus. Earnings have been revised down 60% for oil and gas, and travel and leisure has been revised down 60% as well. So it's interesting. Christian mentioned that Europe doesn't, the European holdings or the index doesn't have the same mix as the US holdings. 20 years ago, the top 10 companies in Europe were telecoms and oil names. It's been slowly changing. Now the tech industry has grown larger than the oil sector and is close to the size of the bank sector. So Europe is changing, and Europe now has its own elite. And Christian and I talked about it a couple of days ago. It's been branded, like a granola. Basically, it's lots of healthcare names, the GlaxoSmithKline or Roche, and some tech names such as ASML and SAP and things like that. There are some elite consumer discretionaries as well, and those would be the Louis Vuitton, L'Oreal, and things like that. But three things that I think we look for in Europe, or how we invest in Europe, is growth, stability, and income. So in Europe, we have an active manager, Euro-Pacific Fund, which most of you have, and they have done a good job picking stocks. Emerging markets. So the Asian emerging markets have also reported weak numbers, and I don't think any of these numbers are surprising us at all. You've got China manufacturing, fixed assets, retail, exports all falling in one big motion. And along with China, you pretty much have the big swath of Korea, of Hong Kong, of Taiwan, Philippines, everybody. But China also sells a bunch to Europe, and so it's interrelated. The two of them will be, will somewhat be linked. So here we are using protection where we can. Many of you are familiar with the buffer notes that we are using now. And as the market and this volatility has given us an opening, we are seeing very good deals over there. Christian?
Yeah, no, thanks very much. I think a very important point about the so-called granola stocks, and we can tell you what they are in the blog. But as what Rita actually named quite a few of them, but they're these kind of big, very blue chip, good cash generating companies, and they tend to be, where they're listed is not really that important. Some are in France, some are in Germany, some are in Switzerland, but those have been very good rebounders and good stocks to have. Okay, let's kind of moving on to the next stock, because we had a lot of questions here and I want to make sure I get to those. Yeah, could you go to the next one, Debbie? Yeah, I'm going to talk about this very quickly because this is a log chart, and I think I mentioned several times some clients before, so forgive me for repeating here, but we were about 200,000, 220,000 weekly claims for the last 3 or 4 years, and if we had a big recession back in 2008, 2009, they went to 600,000-700,000. So this is, again, you put this back, decades, you don't get anything like this kind of, literally standing at a right angle to go up to this level. So a number of claims is about 30 million. add in the number of unemployed at the end of March, it was 7 million, presuming a lot of those people weren't rehired. So roughly, 37 million people have either filed for unemployment or claims in the last 6 weeks, about 20% of the workforce. But, claims, just as a quick warning, is only just measures one side of it. It's people who have lost a job and file for unemployment claims. So it doesn't measure, people who then re-enter the workforce or find another job. That may not be very much, but especially under the current conditions. But we do have a very important number coming out this Friday. That'll be the non-farm payroll numbers. And normally those have been running in the 150 to 200,000 net new jobs. They went negative in March. They'll go massively negative for the April numbers, but not as big as the claims, just because of the methodology survey differentials. But we're going to see an unemployment number which is at least about 12%. It may be higher. It really depends on how many people answer the question, are you looking for work? And I think there'll be a lot of people who say no, because they've been furloughed, or they'll get their job back at some point, or they literally can't. There's nothing. They're not allowed out of the house, and there's absolutely no jobs available for them to do it. So if you answer no, it doesn't matter what the reason is, whether you're furloughed or whether you just waiting for your other job to come back, then you're not measured as unemployed. So if you do see a number of 6, 8 to 10% unemployment, again, no high fives, big clapping, because I think the actual number of people who are sort of economically disenfranchised will be much closer to that 30 million, and that's what matters to GDP and the economy. So important number coming this Friday. Next one. Yeah, I'm going to skip over that one, and then just show, this was the first number that came out. This is measuring first quarter GDP. This came out last week, so it gets revised a lot over the next 6 to 8 weeks. But that, almost 5% number, obviously brings the current economic boom to a grinding halt. Actually, I've always thought that the economic takeoff after 2008 was incredibly weak. We never got above 2% on an annual 4-quarter successive basis. We had some sugar rushes with some tax cuts, with things like the Trump tax cuts, but really this economy was incredibly weak for the longest time. And that's why we had underemployment. We essentially had slow growth, and we had very low inflation. But anyway, now it's come to a massive decline. Now it's the second quarter that counts, because really there's only 2 weeks of the first quarter in here where the economy was in shutdown. So when the second quarter number comes back, at best we'll have 3 to 4 weeks of the economy opening up. The majority of the quarter will be the 8 to 10 weeks that we're going through right now. So that number is going to be, sit down for this one. It's going to be about 20% down on an annualized basis. Now, that doesn't mean the economy shrunk by 20%, but it means it shrunk by about 7% on a year-over-year basis. So those are the kind of the numbers that we're going to be looking at, coming up. And I think the last one is just on healthcare spending, and I'm not going to cover that one. So kind of where we are right now, because I've got some questions I know we want to get to, is on the bond side, it's relatively easy. We look at treasuries. We know what the Fed's doing. 65 to 75 basis points on the 10-year treasury. As long as that stays around there and we don't get a lot of liquidity problems in the bond market, we'll be fine. Corporate credit, I think, is backstop for now. Good quality credit, which we're buying, we'll get a spread of about 1.5%, 2% maybe over a 10-year treasury. We're staying away from high yield, because I think there's still one of the issues going to come a problem in the energy sector and other high yield areas is they're just not going to have the cash to service those debts. So I think those are higher risk areas. On the equity side, I'd love for it to be a period of consolidation. It's been sideways essentially for the last couple of weeks after coming back. Year to date, the S&P is down 11%. It was down at its worst, down 33%. and from its bottom, it's up about 30%. So that explains the V. So down 11 year to date. It'd be difficult to see us doing, a heck of a lot better than that. I think the sectors which are going to do badly are the obvious ones, travel, entertainment, hospitality, these and energy for a different reason have big adjustments to make. The ones that are going to do probably well are healthcare eventually, although not right now because the wrong type of patients are using the medical services, and some of the technology stocks which just seem to be in their own sphere of growing and taking business from other people. So yeah, that's really the kind of the some of our comments. We feel quite good about the level of the market. It seemed come on a little bit fast in April, but the last few weeks it seemed to have settled down a bit and less roaring, which is what I wrote. We had a title a couple of weeks ago, and more just like having roared, it's sort of quietened down a little bit, which is not a bad place to be. So we have a bunch of questions. I'll see just how many if I can get to. I'll take them in the order. I don't know if Rita, you can read them as well. So, maybe we'll do this together. But the first one is question about taxes. I've read of people moving out of cities thinking are safer, but the warning is that small cities in the suburbs will have large deficits and rising taxes will be an issue. Same for states and county governments, which will need to balance budgets. How will this drag down economy and for how long? Some estimates at least 3 years. Yeah, I think I don't know, but people moving out of sort of Manhattanites moving to Long Island and stuff like that. I don't know if that's a really big enough issue, but I do think that the next level of support seems to be able to help some of the states because they're fast running out of their unemployment funds. So that would be a great help, and that will help certainly on the budget side. It gets rather complicated because a lot of states aren't allowed to run deficits. So would this put pressure on their municipal bonds? And what happens if they're kind of driven to the wall? But I think on balance, I think there'll be some help for those, and I don't think it's going to worsen what are always already a big problem. Rita, do you want to add anything to that?
No, I think there are a few that we can probably group together to answer. So we talked about how much the Fed has done, pretty much at coming in, stopping the illiquidity gap and take that out of the equation. A couple of questions are, it's around this. What do we see as the impact of the growing debt on the economy in years to come? And what else it's open for the Fed to do?
Yeah, I love this question because people talk about the Fed being out of bullets and everything else, and the Fed is never out of bullets, and they can do a heck of a lot more. I mean, just an example. Again, this might seem horrific and just nothing that we've ever thought about before, but they can buy stocks. They've already said they're going to buy ETFs, and they backstop some of the high yield bond funds. I mean, they've just said we're open to buying them, buying the underlying securities. The Bank of Japan has been buying stocks. They're one of the largest stockholders in the market. So they could do that. But, but even before they get to that, they could expand the quantitative easing. They include new asset classes in there. In addition to the munis, they could go shorter and longer on those. They could also change the types of bonds that they're willing to backstop by either duration or credit quality. They could do a much more aggressive yield curve management, which is what happened during the Second World War. They could literally say, here's the Fed funds rate, and this is what the 1 year rate, 2 year rate, 3 year rate, all the way out to 10, and every single point on the curve. They could say the minute those go above that rate, we'll be buying it. So essentially it suppresses the entire yield curve. They could also go negative on the federal funds target. Now they said they haven't, but they've also done a lot of things which they said they wouldn't do in the past. And that is, it is a response. I'm not sure it's a great one. The ECB hasn't been too thrilled about it. It's worked for the Bank of Switzerland, but that's about all. Hasn't really worked for Japan, but they could do it, and that could again, help a lot more of their tools. So I think there's a lot more that they can do.
Yeah, and much of this is a matter of confidence. I think you and I were talking about how the Fed has come out to say that they will backstop all kinds of bonds, all kinds of debts, but they actually haven't done much.
Yeah, it's very clever. It's called verbal intervention, Rich. Draghi was very good at it. So we're going to buy anything that comes our way, and so they haven't actually bought the high yield bonds. You're right, but they could.
Right. So there are a couple of questions that I also think are quite interesting. So we were talking about, what the Fed does. One of the questions talks about if we see major failures in cities and states and businesses, wouldn't that further destroy consumer confidence and therefore, further tank the markets? I want to also add together that we are seeing early signs of some large retailers declaring bankruptcy. So for example, J. Crew going into Chapter 11. So what are some of the ripple effects of the supply chain? So I think we can take these together.
Yeah, I think the corporate bankruptcy, that's fine. I mean, that's, some of it's strategic, so they can kind of stave off their creditors and continue to go to business. These aren't, bankruptcies where they close down and there's nothing left. They're more kind of like restructurings. That's fine. I think the States is very unlikely to happen. I mean, if you want to, as Mitch McConnell said, hold New York and California's feet to the fire, then Kentucky's going to be right behind. So the idea of pushing the states into insolvency, I don't know, it could happen. And yes, that would certainly harm consumer confidence, but that means that it gets put into the hands of bankruptcy judges. There's no precedent for it in the states at all. There's no case law on this because I'm allowed to do it. So, I mean, there is for cities, but that's slightly different. But yeah, I mean, in theory, if they said California was to close up business, that would be a major problem, but I don't think it's going to get that far.
Great, thank you. So we're going to answer two more questions, and I'm going to group that in a way that we can handle all together. One relates to retirement accounts, what people should do at various stages. So I'll read off the question, and then I think we'll see. So first one is that advice for clients who are planning to retire in the next 6 months and depend on the portfolio to supplement income. What's the advice here? And also for retirement accounts now, should we go to cash?
Yes. And by the way, thank you for that question. That's from a very good friend of the firm. No, I think cash is yielding 0, and there's better things to be in than 0 yielding accounts. If we're looking for some protection, if there's another market downturn, we have treasuries. Treasuries would do well, whether it's short term or long term. They are going to be the asset class which people go to, run to, hug, and stay with if there's a big trip up in the market. So I think that's where I would put the kind of safe assets rather than the cash. As much as we want to be, where we're using cash, we're trying to use money market funds and treasury money market funds rather than these enhanced money market funds, which can go a little skewy on the credit quality.
What about planning to retire in the 6 months and needing income?
Yeah, I think, I mean, we have some, income types of assets. I think the first thing when I think about it in a broad term is that we're in a low yield environment. And the minute you stretch for yield on the fixed income side, you begin to trip down the credit quality very quickly. And, I would feel, unfortunately, better in a single A, credit. We've started to use bond ladder. We're happy to explain how that works, but, yielding 2.5%, 3% than I would be in, a high yield security oil and gas stock, which normally, has an 8% yield on it, because I think that the default and the risks are going to be, way too high. So I think the other sources of income are real estate, which, we don't want to go into a big diversionary on this, but we think some of the real estate rental incomes are pretty good places to earn income from. And also we pick them up in some of our dividend equity sides. So, we can certainly work on a portfolio which has, supplements overall income.
Great, thank you. All right, so a question came talking about Warren Buffett's remarks yesterday. Do you want to take it? Do you want me to take it?
Why don't you take it? You think you listened to a lot of the call, and then
I know. So Berkshire actually has a very broad portfolio. So we look at it as, sort of it owns a bunch of things across the economy. Some consumer stocks, some transportation, some industrial, some financial. So, it's got a little bit of everything, and some technology too. It also owns Apple. So I think a couple of things that came out from there is rather interesting and, in my opinion, a little bit disappointing. So, we know that the whole consumer behavior is going to change quite a bit, and Warren puts it in his words that the world has changed for airlines, which I think it's probably something that you've read in the last few days. So that's probably true, and that means that a lot of the supply chains and also a lot of the associated industries will probably slow down. So that's quite an important point that he's made. And along with most of the commerce being stopped, the railroads and some of his consumer companies will probably be slowed as well. One of the things that's working well for him is the insurance business. Geico being, an auto insurance company with simple probability, with fewer people driving, fewer accidents, then profit margins improve for them. So among that, among all the industries, this would be one of the brighter spots. The very revealing thing is how he's going to use his cash. So he has sold a number of holdings in April and building on his cash pile. And when he was asked how he will use his cash, his answer, what I was looking for was a buyback or some type of a payback to shareholders. But Warren didn't say that. And I think that's the one part that I was more, thinking, okay, then I think it's something that we need to think about. You all know that we own Berkshire. So that's one of the holdings that we are looking at, critically right now.
Yeah, and I'd agree with all of that. And what's different this time round is that in 2008, 2009, those companies who were in trouble, went to Warren Buffett, and he was the sort of, lender of last resort, and he would issue typically preferreds or convertibles and get a very, very good deal out of them. Then those companies could say, look, we got Warren Buffett behind us now. So there kind of be a restoration of confidence. That hasn't happened this time. The Fed was too quick off the mark. So there isn't a lot of people, calling Nebraska. There probably was on the 2 or 3 days before the Fed moved the rates on the Sunday. But then since that, they don't really need what he can provide. So, we're certainly taking a long, hard look at what, what's happening there. And meanwhile, it's got a lot of cash. It's 137 billion, something like that, out of 400 billion. There was one other question which I kind of answered on the about real estate, and real estate. We're going to see a downturn. I think in some parts, yes. There might be some in sort of more, regional, edge town, office. there'll be some reconfigurement of prime office real estate, but I think less so in multifamily housing, certain types of industrial, particularly warehousing, because they're so integral to the supply chain management, which is, you know, how all the kind of Amazon delivery system, you know, operates and works. And that's what we're mostly investing in. And you know, retail, I think some areas of retail will be hurt, but I don't think we're going to see a big downturn in residential housing, just because the supply is fine. It's not particularly tight. Oversupply, you know, people are not having to move. People aren't over leveraged. Remember, the U.S. households are very under leveraged. You know, they really took down their household debt borrowings considerably after 2008-9, and they've never really built them back up again. So the U.S. consumer might be cash strapped, but they're not leveraged in cash strapped. And so I don't think that's going to translate into a problem on the housing side. We have gone over our allotted time. Thanks very much for all the questions. If you have any others, feel free to, you know, email us direct, or call us on the main number. And I think on our blog there's a email you can certainly send questions, and happy to, you know, fill in what we missed out today. And so at this point, Rita and I would like to say thank you very much. And then I'm going to read the disclosure. Everybody likes a disclosure, so here it comes. And after that, we'll log off. This presentation was prepared as a private communication, not intended for public circulation. It's for the sole use of the person whom is addressed. Privileged and confidential use by any other than the addressee is prohibited. Discussions of the investment strategy, research, investment process of Brown Janikowski was of the date indicator or the date of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. Consultant has no obligation to provide revised assessments in the event of changed circumstances. A consultant cannot assure the type of investments mentioned in this presentation will produce the intended results or outperform any other investments in the future. Consultant reserves the right to change its investment perspectives and outlook without notice as market conditions dictate and as additional information becomes available. Diversification does not protect an asset investor from market risk, does not ensure a profit. The information is subject to unintentional errors, omissions, and changes without notice. While we gather this information from sources we deem reliable, we cannot guarantee the accuracy or completeness of any statements and numerical data in this presentation. References to an individual security is not be construed as a recommendation to buy or sell that security. Securities noted in this presentation are in several unsuccessful investments by the consultant do not represent all of the securities consultant has purchased, sold, or recommended. Index returns include reinvested dividends and interest, but do not reflect commissions or transaction costs. Mutual funds return include reinvested dividends, capital gain distributions. Mutual fund returns are net of the fund expenses, however, they do not reflect the consultant's fees. Please read the prospectus carefully before investing any money. Past performance is no guarantee of future results. We may reference the various hypothetical investment illustrations. They are for illustration purposes only, are not investment recommendations, and do not guarantee any indication of future results. Thank you.